Hi and welcome to this week's Property Insider video as I chat with Dr. Andrew Wilson about what's happening in our housing markets. And property values surged in February, spurred on by record low mortgage rates, improving economic conditions, government incentives and low supply of stock. So we have a chat about what's happening in our markets around Australia and what's going to eventually slow down our price growth. And it's probably not what you think it is. It's definitely not what most people say it is. So if you want to keep up to date each week with what's happening in our property markets, please subscribe to this YouTube video channel and click the little bell icon so we can keep you up to date with our latest shows. It's now the beginning of March and the summer property season's finished with a bang, and property values are rising around Australia and we're getting record auction clearance rates week after week. Sometimes it's hard to remember how lucky we are as a nation compared to the rest of the world, not only from the point of view of COVID-19 cases and its containment, but also how our economy recovered from a short, sharp recession last year and how we're getting on with our lives. Around 90% of the jobs that disappeared due to COVID have recovered, consumer sentiment has increased, household savings has skyrocketed, and we're spending more, and this has led to strong retail sales. Seems lockdowns give many people time to think about, I don't know, how life's too short, and we deserve a reward. So many Australians are out buying cars, camper vans, jet skis, TVs, all sorts of audiovisual equipment, and retailers are running out of stock. Now, this increased confidence, together with the historically low interest rates and pent-up demand, has caused our property markets to rise. We were on pause last year, and now it's stimulated our property markets. And now that we've got a couple of months' data under our belt, it's really a good time to see what's really happening in our property markets, which is exactly what I'd like to discuss today with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Hello, Andrew.
Yes, good morning, Michael, and happy autumn to you.
Yes, we're into autumn. That's right.
No, it's gone quickly, hasn't it? Can you believe we're into March now? March madness in the housing market, perhaps, but we've certainly had a very hot February.
Yes, we did. One of the challenges, though, in such a fast-moving market, Andrew, is having realistic data, because there's quite a lag from data provided by, well, particularly the Australian Bureau of Statistics, but
Yes.
even many of the data providers. So at times like this, I found auction clearance rates are a pretty good indicator of
Yes.
how vendors are feeling, how buyers are feeling. And now that we've had a number of weeks of auction data available, we're getting a good idea of what's happening. So how are you seeing the auction markets around Australia?
Well, we ended February, Michael, as we usually do, with what's regarded or called a super Saturday of auction activity. And of course, that's because, particularly in Melbourne, it is the weekend before the Labor Day long weekend, which is typically the first weekend in March. And vendors obviously try to avoid the distractions of that. So we have a build-up of auction numbers prior to that holiday break. And other markets also reflect that. Other capital cities typically have high numbers in the last weekend of February. We saw that on the weekend. Numbers were a little bit lower, in fact, noticeably lower in both Melbourne and Sydney compared to the same time last year, the same Super Saturday last year, which is interesting. We've just had a sense that auction numbers, listing numbers in Melbourne and Sydney have just started easing over recent weekends, Michael, which is interesting. I think perhaps vendors are holding back, thinking perhaps they can get a higher price down the track, or maybe it's just remember that these decisions that are made by sellers are 4 to 5, maybe 6 weeks old. So they're reflecting decision making some time before. But nonetheless, auction numbers have been a little lower compared to last year. Maybe that or fewer choices is helping to keep clearance rates high, but certainly high they are, Michael. Sydney recorded its highest ever clearance rate at the weekend, finally got to 90%. So 9 out of 10 properties cleared under the hammer that were reported. And other capitals, Melbourne recorded its highest clearance rate for 3 weekends. Now it's got that COVID lockdown issue behind it. And of course, we know that Canberra and Adelaide have been very, very strong. Some weekends pushing over 90%, but they were again in the high 80s. And even our old friend Brisbane just is producing some absolutely remarkable results in the mid 70s, those clearance rates. We've never seen that before, Michael. So these are extraordinary times for our housing markets, particularly for our auction markets. And we can have a quick look at the February results compared to February last year. And although auction prices tend to be volatile because of the mix of properties that we are looking at when we do compare period to period, nonetheless, the trend was clear. Median auction house prices have increased across the board in all capitals. The national median house price increased for houses by 5% over the year. All capital cities were up, pushing towards a 10% increase compared to February last year. And Melbourne was the underperformer, with prices up just by 1.7%, perhaps some COVID issues there. But certainly there is no doubt that prices are on the move. We shouldn't be surprised given how high clearance rates have been. As you said in the introduction, Michael, it is a very accurate way of looking at underlying activity in our housing markets, those weekend clearance rates. So onwards and upwards, we will have fewer auctions over the next weekend until we build up again. And our next Super Saturday will be the weekend before Easter, and that'll give buyers another chance. But this is a hot market, Michael. Prices are rising quite strongly. The latest information when we look at listings, and that's total listings coming through over the past week, not just auction listings, we've seen another uptick in sellers coming into the market. So as I said, those auction numbers do reflect seller sentiment of about a month or so ago, but the latest sentiment is showing there's still plenty of choices for buyers out there.
Well, as we often say, sellers are buyers and buyers are sellers, and we're wondering why sellers aren't putting their properties on the market. I agree with you. Some are wondering, hey, maybe I should just hold on, it'll be worth more later. Others are wondering, should I buy first? Should I sell first? And they're having difficulty even finding something to buy. So there's that dilemma that happens in a hot market. But you're noticing there's more listings coming on the market at the moment.
Yes, Michael, just over the last week, of course, we had a shortage of listings, a pause in listing numbers in Melbourne during the 5-day shutdown. No surprise there. So the surge in Melbourne listings over the past week is catch up from that pause period. But even the other capital city markets recorded increase in listings over the past week. That's total listings. So again, it's a market that's being certainly fertilised quite robustly by both buyers and sellers at the moment. And we're looking at certainly a record February market, and moving into March, it's certainly no sign of it slowing down. And we are going to see significant price rises this year, I'm sure.
Well, what's going to stop prices going up? We've been talking about that the last couple of weeks. And while I'm already hearing people saying the Reserve Bank's going to put up interest rates, APRA is going to get involved, I think we both agree there's something different that's going to affect that. What's going to put a ceiling on prices eventually is going to be affordability. And the most recent wages figures coming out from the Australian Bureau of Statistics showed that wages aren't going up much at all. So affordability is going to be impeded.
Yeah, absolutely right, Michael. I think it's highly unlikely that the Reserve Bank would raise interest rates. That's cloud cuckoo land stuff. Just when our economy's getting off the ground, off the floor, the last thing we would need would be higher interest rates. And that would really question the competence of the Reserve Bank if they even thought of doing that. And the same for APRA. We're still suffering in the investor market from those APRA actions of 5 or 6 years ago. No, I think that it will be affordability. As you said, the wage index data last week was again sobering. Annual increase in wages over the December quarter, that's December quarter to December quarter, was just 1.4%. That's the lowest on record, the same as we recorded over the September quarter. Of course, there are underlying factors to do with COVID and income support that has pushed those income growth numbers to record low levels. But the point is, it's not going to grow quickly anytime soon. And even if we got back to where we were, Michael, prior to coronavirus, and we were only tracking at around about 2% per year in terms of wages growth, which is well below our peaks of up to 4%, we just don't have the capacity with this very low incomes growth to continue to support price increases. You can't go to the bank and say, look, I want another 50 grand, and you're still earning the same amount of money and interest rates are the same. And that's what'll taper out house price growth, and it is putting a ceiling on it, and even more so given that these income levels will remain near record lows for some time to come. And look, that's not good news for consumers anyway. If we're not getting incomes growth, once the JobKeeper allowance finishes, that's going to put a tap on that to some degree, which we've discussed is quite modest, I believe. But nonetheless, we do have this handbrake in terms of incomes growth that will ease house price growth once affordability starts to decline, which it will, I believe, over the next 6 months.
That doesn't mean our property values are going to crash afterwards, because the property prices going up at the moment are really underpinned by owner occupiers who've taken on mortgages they can afford. So under current conditions, there's no reason for APRA to intervene. Investors
No,
aren't speculating.
no.
And it just means that the cycle's going to move on and slow down a little bit.
Absolutely, Michael. And, any discussion about APRA's involvement is just ignoring the actual evidence. And the evidence is quite clear. As you said, this is a remarkable cycle because it's not being driven by investors. Normally, when we're getting this type of appetite for property, a significant proportion of it is being driven by the animal spirits of investors. We still have investor market share at record low levels. Yes, investor numbers in absolute terms have increased over the last few months. But in terms of market share, it still remains at around 20% of total lending, which when we look at previous periods when prices have been increasing as strongly as they will be in prospect now, we've seen investor activity at over 40%. So we're at half that now. So which means that these, as you said, this owner occupier activity, a much more stable environment for lending conditions, and no reason at all for APRA to step in. There seems to be an ideological view from APRA, Reserve Bank and Treasury about the housing market. They got their fingers burnt with policy decisions they've made previous to that. Let's hope they stay out of this and have faith that the market and our robust and rigid banking sector will eventually ease price growth once we start to reduce affordability.
Over the years, there's been talk about how long does a property cycle last? Is it 7 years between one peak and the next? I've noticed over time cycles have become a bit shorter, but I think this time it's a very different cycle. Again, every cycle is different, but all the markets, other than really the new and off the plan in the CBD markets, are doing well. Regional, each of the capital cities. So it's quite different to previous cycles, Andrew.
Yes, well, this is the point, Mike. You can't really look back to go forward because when we understand the house price cycle, it's the interest rate cycle. It's one and the same. And the point now is we have just about zero interest rates, which aren't going anywhere downwards. And we know they're not going anywhere upwards because that would kill the economy. So that cycle is flat, which means our housing cycle is flat. And the point is that we can't look back because we've never been in this position before. Normally, when we're getting strong house price growth and consumer spending, which we have, interest rates are on the rise because the Reserve Bank starts to be concerned about inflation. So typically in this cycle, we'd have interest rates increasing, but of course, we're not going to see that at all. This is completely different. So we can't measure this as being part of a long-term system of house price growth and just part of a cycle within that system. The system was never there to start with because it's about the macro economy. Things change, Michael, and we're in this position we've never been in before. And hopefully, and I believe, once the affordability advantages expire, we'll have a much flatter and a much more sustainable housing market cycle going forward because interest rates will be as flat as a tack.
Of course, the rental markets aren't performing as strongly as the housing market. So I'd like to come back next week, Andrew, and have a
Yes.
chat about what's happening to the rental markets around Australia, which is interesting if you're a tenant because you've got more choices, and also as an investor because you're wondering what's happening to your cash flow. So I look forward to catching up with you again next week, Andrew.
Yeah, thanks very much, Michael.